Hi, folks. Welcome. Thank you all so much for joining us. We're going to get started in a minute or two, but thank you so much for being on time. Again, thank you all so much for joining. We're going to get started in about 30 seconds or so. Okay, thank you all so much for joining us. We'll give folks a few minutes or so to trickle in, but I'll just go ahead and get started with introductions. Welcome. Thank you all so much again for joining. My name is Nirmala Singh, I'm one of the founding board members of South Queens Women's March, and I'm so honored and thrilled to have you all here with us today. For those of you who are joining us again for one of our workshops, welcome back. For folks that are joining us for the first time, welcome to South Queens Women's March. We are a volunteer-led and intersectional organization working to foster women's empowerment by dismantling patriarchy and gender injustice hyperlocally, primarily here in South Queens. And so today's a very important workshop, as we know. So sorry. Economic empowerment is key to achieving true gender equity, and our conversation today is very important as it will help to talk a little bit about the generics of personal finance, but we're also going to be focusing a little bit more on women, the salary pay range law, and a wide variety of different things tied primarily to women within this field. I'm very grateful for our three amazing speakers who are here joining us today, shedding their expertise on this topic, as well as Nicole Cobham, who is one of our fantastic members and really helped to put together this workshop. So I will now turn it over to Nicole. Before I do that, I also want to flag that we are streaming live to Facebook. That's for folks who are unable to join us via Zoom, as well as recording this session to ensure that it's accessible for everyone who is unable to join due to another commitment. But feel free to utilize the chat box at any time if you have any questions throughout the presentation. We will also have time towards the end for an open Q&A. So if you want to save your questions then too, that's totally fine. But thank you all so much again for joining us, and I'll pass it over to Nicole now.
Thank you, Nirmala, and thank you everyone for joining us this evening. My name is Nicole Cobham, and I'll be your moderator today. So a little bit about myself before we jump in. Senior at KPMG, and I am on the Youth and Professional Development Committee here at South Queens Women's March. So super excited to have you guys all here today. So let me just share my screen so we can get started. Let me see, okay, see my screen. Yes, okay, great. So today we're here to talk to you guys about personal finance. A little overview of what we're going to be going over today is the importance of financial literacy, managing credit, budgeting, investing, and then women in informed decisions. So before we get started and jumping in, I want to give the time for our three speakers to give a little introductions about themselves. So if Nikolai, you want to get started, and you can kind of go down the list if you get a little bit about yourself.
Sure, thanks, Nicole. My name is Nikolai Botita, and I am an investment banking analyst at Bank of America. Grew up in central New Jersey, spent a few years in the Washington, D.C. area when I was in school, and most recently, I'm living in the New York City area in Manhattan, and I'm excited today to be here and talk a bit about personal finance.
Thank you. Mary?
Hi, everybody. I'm Mary Luke, and I am not a finance person, so good, right? I'm an advocate, and on the board of a group called Power New York, which really advocates for economic empowerment as well as childcare and against gender-based violence. So a whole bunch of issues related to women's empowerment. I'm also on the board of UN Women USA. And of course, we take a global look at the same kinds of issues around how we can really support women around the world. Nice to be here. Thank you.
Great, thank you. And lastly, George.
Hey everyone, my name is George Guan. I'm a current associate at KPMG. Born and raised here in New York. Grew up in Corona actually, and now moved out here to Bayside. So very excited to be here and help guide you along your financial journey.
Great.
So,
Yep, thank you. All right, so we'll get started. Jarl, I'll kick it off to you.
yes, thank you, Nicole, and thank everyone else for being here. So to kick off the Personal Finance 101 session, we'll begin speaking about financial literacy, what exactly it is and why is it important. So simply put, financial literacy is someone's ability to understand and use financial skills. These are skills such as personal finance, budgeting, and investing. All things that sound so simple, yet can be complicated. Now, you might hear others say financial capability, but in essence, it is the same thing. So financial literacy equals financial capability. And without it, some folks may struggle to meet certain ends and achieve financial well-being. Now, the reason why we're doing this today is because there is such a huge disparity in the rates of financial literacy all throughout the United States amongst the different racial and ethnic groups, especially with BIPOC populations tending to have lower rates of financial literacy. Now, closing this racial wealth gap in the United States is a challenging issue with no solution that fits all. But by expanding financial literacy, we hope to empower folks to reach that success. Now, understanding financial literacy can have such a huge impact in anyone's finances. We use credit cards and mortgages and student loans to finance our needs and to achieve a goal. But there are ways to successfully navigate those items to achieve financial success. Now, if we look over to the right side of the screen in the Did You Know, we have some quick facts about financial literacy that is interesting to understand. So about half of all Americans in the country have a tough time keeping up with monthly expenses. Now, that could be as a result from not budgeting. It could be resulting from spending too much. And we're here to kind of guide you along that. We've also found that women tend to have lower levels of financial literacy than men. As our country grows, families of color will soon become the majority of families here in the United States. But yet, white families continue to be building wealth at a faster rate than people of color. Now, there's new consensus data that shows that white families on average have 18 to 20 times more the net worth than people of color. So again, we want to welcome everyone to this workshop, and we hope that you find this workshop helpful to empower yourselves to reach your financial success. Next slide, please, Nicole. Okay, we're going to move on to managing credit and what is credit. So credit is going to be one of those foundations of personal finance to keep in the back of your mind. So generally what credit is a contractual agreement between you and the creditor, the person who's lending you money, that you will return and repay back that sum of money that you've borrowed, generally with interest as payment for borrowing that money. So just think of credit as your trustworthiness to a bank on how much and if they will lend you money. Now, when we talk credit, we typically think of the 5 C's of credit. Think of these as the 5 pillars that move your credit and your credit scores. So the first C is going to be capacity. It is essentially your debt to income ratio. So if you're making $100 and your credit card bill is $90, you're using a 90% ratio. That's just a little bit too high. You definitely want to pay that debt down in order to be in a better position. The second C is capital. In finance, capital simply means how much money you have to play with. It is the money that sits in your bank accounts, your savings accounts, and in your brokerage accounts. Highly recommend everyone to pay yourselves first in order to build up this capital. So I really want to stress the fact that of paying yourself first. Now, most people, when they receive a paycheck, they pay their debts first and then save whatever is remaining. It's the wrong thought process. I really encourage everyone here to, when you receive a paycheck, to pay yourself first. Put a percentage on it, withdraw that money from your paycheck and pay yourself first. Then pay your debts, and then whatever money you have left over, that is your spending money. The third C is going to be collateral. It's an asset that will be used as a security for a loan. So think of if you're going to start a business and you're asking for a $500,000 loan. The bank is going to see that as high risk unless you have something to put up as security. So typically people will put up their housing as collateral. Fourth, conditions. This is the why. Why do you need this credit? Why do you need this loan? How much do you need? What are the interest rates? And lastly, character. It's how you are as a person. Do you consistently miss payments? Are you getting in trouble with the law? Are you bouncing checks? No, you want to have good character and good character judgment in order for the banks to perceive you as a low risk applicant. Now, having credits and having access to credit opens doors to opportunities. The timing here is the question. Do you want to do that now or do you want to do it later? That timing is the difference between good debt and bad debt. So some examples of good debt is a reasonable mortgage payment. When you have a mortgage, you are building equity in your house. That is yours. A reasonable car loan, if you're 21 years old, you're just coming out of college, there's no need for you to drive a BMW M5. You don't need that. Student loans is a good way to help you build that credit history, which we will get into later. Now, what is not good debt, what is bad debt, is excessive credit card spending. Trust me, I love shopping too, but you need to hold back the impulse buying. Don't go just because you have a credit card, and don't go swiping, because that's what digs the hole deeper and deeper. Don't go for store credit cards. They have excessively high interest rates that you don't want to pay. That's just extra money that is leaving your pocket. So again, credit unlocks opportunities. It's about timing. Next slide, please. Okay, so now that we know what credit is, I wanted to speak about a credit score. So typically a credit score is a 3-digit number that helps a lender assess and predict how likely you are to repay a loan and repay a loan on time. It's essentially how risky the bank perceives you. Now, a credit score will change very often from month to month, point by point. Now, how you do in your personal finances has a huge impact on the changing in your credit score. Like I've said, credit unlocks opportunity. Your past credit is what is your future credit. It opens those doors for you. Now, a lot of us have heard FICO scores, and what exactly is FICO? So FICO stands for the Fair Isaacs and Company. It was one of the first analytics companies that took data inputs and used that to produce a numerical value to help help and assist banks on risk ratings. A credit score ranges typically between 350 to 850, with that number being higher, the better terms and offers that you will receive. The average American credit score is 660. Now, I want to speak a little bit about Vantage Scores SM. It is a new credit scoring system being developed by the three big credit bureaus, ranging from 501 to 990. So this will be coming in and phasing in and replacing the FICO scores that range between 350 and 850. Now, so the three big credit reporting agencies are Equifax, Experian, and TransUnion. They will all provide different credit scores, but within ranges of each other. So it's a good idea to view all three credit reports and take an average, and that average will serve as your credit score. I recommend everyone here to be checking up on their credit reports month to month. And you can get your free credit report at www.annualcreditreport.com. Remember, it is free. You should not have to pay for it. And contrary to popular belief, when you check your credit score, it does not go down. It is there to help you. So you're probably looking at me and thinking, great, only banks are looking at my credit score to determine how much money that they're going to give me. Yes and no. They're probably going to be the biggest people in your life that are looking at it, but we have others that will also look at it. So for example, if you are planning on joining the military will look at your credit score as a way to assign you a MOS or a job within the military. Obviously, if you have a high credit score, it shows that you can manage finances and you might get a better job. Cell phone companies, they want to see whether or not you're reliable on making those payments. Utility companies, same thing. Employers are looking at your credit score. If you can't manage your own money, then how can an employer trust you to manage even bigger money? Insurance carriers are looking at you and your credit score to assess your risk rating, whether or not they want to cover you. There are rental agents and banks who are, again, looking at your credit score to determine whether or not you satisfy their risk appetite. Now, I want to shift everyone's attention to the right side of the screen. It is super important that we dive deep into this and really understand what breaks down and what makes up a credit score, what goes into it. The biggest factor that goes into it at 35% is your payment history. Are you making your payments consistently and on time? There's typically a 30, 60, 90-day rule that is a bit more complex. And for those of you who are interested, you feel free to reach out to me after this. The second thing is how much you owe at 30%. So think of this as a credit utilization ratio. If on your credit card, everyone has a credit limit of how much you can spend. So let's say that your credit limit is $100 and you spend $90 of it. Your ratio is 90%. It is extremely high. And if I was a bank, I'm going to think, will you have enough funds to service that debt to me? Because as the bank, I want my money. So this goes back into saving and paying down your credit cards and cutting down the excessive spending. You typically want to retain your credit utilization at 10% or under. It's the general rule. Coming in at third place is length of credit history at 15%. So for those of you who are parents, I highly suggest you starting your children off with a starter credit card when they're entering college. The length of credit, it creates a track report of you managing and growing your credit history with different institutions. Lastly, for the fourth item is new history at 10%. Banks are seeing how often you are opening up credit card accounts. If you're opening up new credit card accounts and spending it so often, it's showing that you don't know how to manage your money. Pick a couple that you like, stick with it, don't spend too much, and keep it under 10%. And lastly, the different types of credit used. Nicole, can we flip back to the previous slide? So the good debt side, it's a great example of the different types of credit. For example, the mortgage, the housing, the automobile, the student loans, the business, the small credit card load. These are all debt, yes, but these are 5 different types of debt. And creditors like to see that you're able to manage not only the amount of debt and the repayment, but different types of it. Next slide, please. And next slide, please. Okay, so we have come to the tips and tricks of managing some credit. So we all have one of these. We all have an iPhone, and when we update our iPhone, it tells us to accept the terms and conditions, and we just scroll down and we hit accept. I know you do, I do it too. But when you're making a big purchase like a house or a car, and you get one of those contracts that are this thick, you don't want to read that, but I encourage you to read that. There are so many terms and regulations and conditions in those contracts that you need to be aware of in order to navigate that repayment process. Stay away from stored credit cards. I know it's really, really impulsive when you're at the checkout at Target or Walmart or Macy's and tell you can save 20% on your purchase if you open up a credit card right now. It's there to get you and to get you to spend more money and to make you pay those higher interest rates. You don't want that. Stay away from it. The third point, avoid getting too many credit cards. You know, it's so many, like you're gonna have a lot of accounts. Like I said, pick a couple that you like and stick with them. Beware of the monthly minimum payment trap. Yes, you spend $1,000, but the minimum is only $200. You're going to be inclined to just pay that $200 and think that you have more money to spend. It doesn't work like that. The interest on it is what is going to eat you up alive and dig you into a deeper hole. Pay your monthly balance every single month to stay ahead. The 5th bullet point is the home equity line of credit. This is a little more complex. It essentially means that when you are making mortgage payments, you are building up equity in your house, and you can borrow against that line of equity, that line of credit, to finance other items such as construction on that house. And some strategies for maintaining a positive credit: be good to the banks. You know, practice good banking techniques. Don't bounce checks. Review your banking statements. Make sure everything is accurate. If you're good to the banks will unlock so many opportunities for you. Pay your bills on time and consistently. Don't avoid bankruptcy. Don't spend more than what you have. Try to stay out of trouble. When you're getting in trouble, it's not just a fine. It stays with you for a long time. You know, avoid the stored credit cards. And here's a really important one: removing errors from a credit report. It's so important to check your credit report on a month-to-month basis, because you never know if your social security information might have been stolen and someone may be opening up credit cards in your name and spending money in your name. That it's so dangerous, but it happens so often. Check it for those items. If you see something that you don't recognize, call them. Call them and dispute it. You don't want something that is not yours on your credit report that will stay with you forever. And again, maintaining reasonable amounts of unused credit. Keep your credit usage under 10%. So that means if your credit line is $1,000, don't go above $100 spent. Okay. And I think that is it for credit, right? So next slide.
Great, thank you.
Cool, thanks.
All right, so next we have budgeting, and I will pass this on to Nikolai.
Awesome. Thank you very much, Nicole, and thank you, George. So what is a budget and why is it important? So a budget is essentially there to measure the money you make and then how you spend it, how it's being allocated. So it is a tool that is used to record and track your expected income and your spending plan. And so a budget is important because it can help you achieve your goals. It serves as a roadmap, as snapshots in time, whether it be on a month-to-month basis or a year-to-year basis, of what you're doing with the money that comes in the door and how you're spending it and where you're allocating it to. So before you make a budget, it's important to understand where your money is currently going. And so for me personally, I actually made a budget last year, and after just a month, I very quickly realized that I was significantly off on a few different parts of that budget. And so, whether it's at the beginning or after a couple of weeks or after a month, it's very important to keep track of how you're actually spending your money, so that as you grow and develop your plan, you can make those adjustments. So a budget can help you with several things. It can help you with putting aside money for savings goals. It can help you prepare for regular expenses, whether it just be groceries, or maybe you're paying for a gym membership, or maybe you're planning on buying a new pair of sneakers or cleats for an upcoming sports season. It can also help you prepare for unexpected expenses. Maybe your car breaks down, or maybe a relative of yours needs help paying for something, or you want to make a surprise purchase for someone or for yourself even. A budget can also help you with controlling how you spend your money. Again, when you're going through your day-to-day, it's easy to make impulse purchases. It's very easy to say, oh, I'm sure this is fine, it'll all work out. But when you come together and put together a plan, it's much easier to see where you actually have space for these things. It also helps you reduce stress and increase confidence. Budgeting and finances, like George mentioned before, can be really, really scary. And oftentimes it's just easiest not to think about these issues and to say, oh, I'll deal with it later. I'll think about it later. But it's this kind of a habit that allows you to maybe dig yourself into a hole that you might not be able to get out of. And so it's really important to keep an eye on what you're spending, coming in with a plan, ultimately, so you can manage all of your expenses. And at the end of the day, if you have a budget, it does provide an excuse for you to calm down on some of those impulse purchases. So with that, can we go to the next slide? Awesome. So how do I make a budget or spending plan? So it is really, really important to understand your personal financial situation. What are your wants versus your needs? What are your values? What's your life situation? What stage of life are you in? Are you, young, maybe out of high school or college with limited expenses yourself, maybe student loans, or maybe you're in your 30s or your 40s. Maybe you have a child to take care of, or multiple children, a partner. So it's really important to establish where you are and what your goals are. And so once you're able to establish the things that are important to you, that's where you can begin to set those personal and financial goals. And whether that be saving money for retirement, saving money to get an education, to maybe pay for a child's education or a relative's education. So once you have those personal and financial goals, it's time to create a budget. Figure out what your fixed and variable expenses are based off of your projected income. If you make more money over time, you're going to likely pay more in taxes. If you make less money, you'll likely pay a little less in taxes. How often a week are you going to go out to eat? The more often you go out, you'll probably end up spending more money. The less often you go out, that's an opportunity to save money. And like I mentioned before, it's important to monitor your current spending, your saving patterns, your investing patterns. And then after you do that, compare your budget to what you actually spent. And then as you do that, continue to review and note those steps that, month to month or year to year, you're making towards those financial goals, and then make adjustments as you go. One really important thing to note is that emergency fund. There are millions of Americans and people around the world who do not have the finances in place to handle an emergency expense of more than $500. And in many instances, if your car breaks down and something happens, those kind of expenses could be thousands of dollars. And so it's extraordinarily important that one of your first financial goals is that if you don't already have an emergency fund in place, it is really important to have something in place, because the last thing you want to find yourself doing is paying for those emergency expenses with sources of bad debt, like high interest credit cards, or home equity lines of credit, or other sources of very expensive money. Next slide, please. So a few tips, think about your goals and your dreams, because that is where everything starts. Determine what is important to you, but really what you need versus what you want. What are the nice to haves in life? Like George mentioned before, I don't need to buy a BMW. Most people don't need to buy a BMW. A good old Toyota Corolla will, get the job done. And then make and implement a plan and continue to evaluate it weekly, monthly, yearly. Make those adjustments and stay informed about your options for how you can adjust your budget. And ultimately, it's these decisions that will allow you move towards financial freedom and financial success. So just a couple of tips to keep in mind as you're going through to reduce your spending. Do shopping comparisons, use coupons. I used to get really mad at my dad for digging through, his wallet to pull out some coupons out of the supermarket. But, these things do really add up over time. So, use those coupons, avoid impulse purchases. If you can get something on sale, great. But just because it's on sale, it doesn't mean you should buy it. And then, do you need to get a car? Maybe you can walk instead, or carpool with someone, or take a bike, or take the subway. And then don't use use frequent shopper cards. If there's something that's important to you, where you can get membership rewards or rewards for if you go to Chipotle a bunch of times and you get a free bowl, those are ways in which you can reduce your spending. Next slide, please. All right, so now we're going to jump into investing. So what is the purpose of investing? Purpose is to achieve your goals. And so you can have shorter term goals, and you can have long-term goals, and you can have medium-term goals. Typically, when people think of investing, they think of saving and making additional money with the money that they currently have to achieve some kind of goal. So a lot of times people think of retirement. For some of us, that's 40 or 50 years away. For others of us, it might be 20 years away, 10 years away. But no matter where you are in life, it's important to begin saving for retirement. A little later, we're going to show an example that shows how quickly your money can accumulate and grow over the long run if you choose to put some money aside for retirement, and for saving, and for your investing goals. And then you have short-term goals. Maybe you are looking to buy a car in the next year, or maybe you're looking to take a class or get a certificate. You can buy short-term investments where there is little risk involved, where you can take that money and use it to make a little bit more, just to make those purchases a little easier. Next slide, please. So why is it important to start early? I think you can ignore most of the numbers on this page, But if you look at the left side, you see two different examples. The top example is someone who starts saving for retirement at the age of 25. And then below that, you see a person who starts saving for retirement at the age of 40. And if you shift over to the red boxes on the right, you can see that the person who starts saving for retirement at the age of 25, 40 years before they expect to retire, in this case, can save about $1.7 million, or about $500,000 in today's purchasing power. Where someone who's 40 today and saves until they're 65, so 25 years, is only able to save a bit over $500,000, or about $260,000 in today's purchasing value. It is incredible how much 15 years or even 10 years or 5 years can make, and how much money you have in retirement. So for the person who started at 25 in retirement, they're expecting to use their retirement funds to pay themselves about $45,000 a year. And for the person who started when they're 40, it's about half of that, only $23,000. So this just really, really goes to show how important it is to start saving as soon as possible, even if it's $50 a month or $100 a month. Whatever you can do to start saving now for retirement is extremely important. And it's also important to take advantage of any employer match opportunities. In many cases, employers, if you put 3% into a 401k, they'll match that up to a certain amount. So there's also some free money that is on the table for you and for your retirement. Next slide, please. So what are some ways to invest? So there's several ways to invest money. I'd say the biggest two that are accessible to the majority of people are stocks and bonds. So what is a stock? A stock is a very small piece of a company. And so you can open a brokerage account with a bank, and you can buy a small fraction of a company. For example, it could be Starbucks, or it could be Apple, or it could be GameStop. And so as this company grows over time and increases in value, you also are able to reap the benefits of that growth. But on the flip side of that, if this company doesn't perform and doesn't grow over time, you're also at risk of losing money as the value of that company declines. But generally speaking, the value of public companies, of stocks, goes up at about 6 to 7% per year over a very long period of time. And so a lot of people encourage investing in a diverse pool of companies, choosing maybe 20 to 30 different companies that interest you. If you choose to invest in specific companies. Another option is to invest in funds. So funds are pooled instruments. So what that means is that you buy a share, and the money that you used to buy the share goes to a portfolio manager. And so these managers typically have a defined strategy, and they'll invest that strategy. Maybe their goal is to get a certain percent return. Maybe it's 5%, maybe it's 10%. And they could look to invest in certain kinds of companies, maybe technology companies, real estate companies. But whatever it is, you are taking some of the pain out of investing by giving your money to a person who has a defined strategy. So that's what you see in mutual funds a lot of the time. We also have exchange traded funds, which are called ETFs. And in those typically track an index. So you may have heard of the S&P 500 or the Dow Jones or the NASDAQ. These are major indices that track the performance of a large group of companies. So the S&P 500 tracks the 500 largest companies that are listed here in the US. And so these are another way for you to kind of take the decision making out of the process and buy a large basket of companies that will generally, over the long run, provide about 6 to 7% per year. The other common thing is bonds. So bonds are typically seen as safer investments. You give X amount of dollars up front. Each month or every few months, they'll pay a certain percent on the amount that you gave. It could be 2% or 3% or 4%. And then at the end of a period of time, maybe it's 5 years, maybe it's 10 years, it could also be 30 years, they'll give you that X amount of dollars back. And so these three vehicles are really the main way that most people, that most Americans invest. Typically, younger people will invest predominantly in stocks because there's more room for growth. So maybe they'll do 80% in stocks and 20% in bonds. Whereas as you grow and become older and you don't have the capacity to put your money in riskier assets, oftentimes people will shift more towards bonds, which are seen as a safer asset. And so someone who is nearing retirement might be 80% or 90% or even 100% in bonds. Some other investment vehicles are investment trusts, the most popular being REITs. So those are real estate investment trusts. It's a way for people to gain exposure to real estate without actually buying a property. Then you have alternative investments like hedge funds and private equity. These are typically only available to high net worth individuals who have a significant amount of money, typically hundreds of thousands or millions of dollars. And then you have options and derivatives. These are typically only available, again, to high net worth individuals, institutional investors, traders who work for financial companies, where these can be used to either increase your risk and also your potential return, or be used to decrease your risk. As a retail trader, as an everyday trader, as just a normal person, you typically need to have upwards of $50,000 or $100,000 in your brokerage account in order to be able to access these. And oftentimes, a investment professional from the broker that you invest with, they will typically have to call you up and do a knowledge test with you to make sure that you understand options and derivatives in order to give you the permission to trade these in your account. And then last but not least, you also have commodities. So these are oftentimes contracts or indices that track metals, oil, grain, animal products, different kinds of currencies, financial instruments. These are all typically fairly complex financial products, but can be accessed in the form of ETFs as well. Next slide, please. So just to wrap on investing, a few tips. It's important to know why you're investing. What are your goals? Are you early in your career? Are you young and can afford to take on a bit of risk, so you can invest more in stocks? Or are you nearing retirement and you want to make sure that in 5 years that money is still there and you can choose to invest in safer asset classes like bonds? Never invest in something that you don't personally understand. If you don't understand the instrument that you're trading in or purchasing, oftentimes it can lead to panic selling. If things move in a direction that you don't expect, you might not be able to handle that. You might not be prepared to handle that situation. Remove emotions as best you can. The scary thing about the stock market and investments is that they can go up and they can also go down. And so it's important to be able to evaluate what you're purchasing, or know that you're investing for the long run and that ups and downs are part of the investing process. Invest in what you know. If it's something you understand, it's much easier to wrap your head around it, and it also allows you to make smarter decisions when it comes to knowing when to buy or knowing when to sell. And importantly, start early. Back to the 401k example, the earlier start, the more time there is for your money to grow. And you'll see the benefits of that over the years. Like I said before, buy and hold. don't be afraid if the stock market, goes down really fast. That doesn't necessarily mean that it's the right decision to sell. And be safe. It's you should diversify your assets. If your investments, you don't care to monitor them every day. I know personally for me, I choose not to look at mine every day, and so I'm invested in a number of different companies. It's generally just safer to invest across a broad portfolio of companies. Thank you.
Great. Thank you, Nikolai. I appreciate it. Thank you for giving us that background on budgeting and investing, as well as George on managing credit. So now I will pass this off to Mary to talk about the impact of women and important financial decisions.
Right. Thank you so much. And that was great, George and Nikolai. I wish, in fact, when I was 20, that I had had the benefit of that kind of information. Because frankly, as a woman, and I think most of this group perhaps are women, there are really, women tend to be financially ignorant, and we call it poor financial literacy. We know that so few women basically are even able to read a financial statement. And so I'm going to really talk just very, very briefly about what's the difference here. That women actually earn more money, they save less money, and they live longer. So that's a formula for disaster. Women also tend to drop out of the workforce to take care of children or their parents or family members. And many times, the rate of divorce is very high, and women suffer more from divorce because they are often left with many more burdens. And so, when it comes to really thinking 20, 30, 40 years into the future, nobody has the ability to think about retirement planning. And that's all wrong. So let's go to the next slide. I'm just going to go through this quickly because I know we're out of time. But this just gives you an idea of the gender dimensions of how, women and men and others view finance in their capacity. So men have a lot higher financial literacy. They save more. They basically have more retirement. And frankly, the only place where women beat them is they have a lot more unpaid medical bills. So that just gives you a snapshot about the difference between how men and women are handling their money. So I'm going to really focus mainly my talk. You want to go to the next slide, Nicole? On how much do women earn? So we've been talking about how much you can save and credit and all that, but fundamentally, we really have to talk about how much, or in fact, how little women earn. And if you look at this, which is the most recent table on the wage gaps for women, you get to see that Latina women are really at the bottom of the scale. I mean, they only make 56 cents to the dollar that every white man earns. That's atrocious. But if you look at the top of the scale, it says Asian American women, it's 85.5 cents. But that's not real, because if I think many of you probably come from different Asian groups. And if you disaggregate Asian women into Asian Pacific Islanders and Native Hawaiians, you'll get to see that many of these groups, like Cambodians, Nepalese, Tongans, are also at the bottom of the scale, just like Native Americans and Latinas. So basically, we know that women, by and large, and of course, there are many, many immigrant women in this group, and many, many women of color really are severely disadvantaged when it comes to wages. So what we do at PowHer is we really advocate for equal pay. It's one of our biggest campaigns. And basically, we do that in a couple of different ways. You want to go to the next slide? And this is where I think maybe we have a lot in common with you in your strategies. So we really believe that it's important to advocate with the city council, with the state, and just recently in March, we had our 14th Equal Pay Rally, where it was wonderful because this is in the middle is Adrienne Adams, who's the new speaker. And we had probably about 15 or 20 new city council women, including the ones from Queens, for instance, who were all really supportive of equal pay for women of color, especially. And so we've really been successful in doing that. There are two different laws that have been implemented, or one's been implemented and another one is about to be. And one is salary history, which means, you know, that you basically, when you're applying for a job, you do not have to disclose your former salary. And why is that important? Because then you don't get pegged to that level. You can really be able to look at, you know, what the job is really worth and be able to negotiate. So negotiation is a very, very important skill for women to be able to increase their salary, increase their pay, and remove this gender pay gap. The other bill that just became law is in New York. You may have heard about it, and I know, and I thank Maria for having all of you sign off on a letter to contest the amendments that were introduced to the salary range law. And the salary range law basically gives people a chance, both people who are working in companies as well as applying for jobs, to know what the salary range is for that job. And that's a great advantage because then you know basically what you're going to be negotiating on. And you also can choose basically not even to apply for a job if you think that the salary range is really below, you know, what your expectations are. So it gives a lot of power to the person. And again, women are really at a disadvantage with this pay gap, and we need to find all these ways to help women really really address the discrimination and the biases that they face in the workplace. And so those are two laws that we really are working on. Actually, in New York State, we're about to really work with the state legislature on a salary range bill for New York State, having succeeded in, you know, getting the one in New York City approved. And I think another aspect that's so important is for women not only to have all this information, but to be able to be trained and have the confidence to negotiate what your salary should be. And that's so important. I mean, this is a whole different, you know, ball game and almost a whole different session that we could spend time on, you know, on this whole area. But I thought it was really a nice way to end this conversation around, you know, how do you actually get yourself into the position where you're going to be able to make a better salary, and hopefully one that's equal to men or others who are actually working in the same job, and you want to be paid equally. So I think that's the end of my little discussion, and maybe open up for questions.
Great. Thank you so much, Mary. All great work and fair points. So I'll give, I know we have a few minutes left, open up the floor if anyone has any questions for any of our panelists. And feel free to, whether you want to unmute yourself, utilize the chat. I think there's a question. Oh, sorry.
Hi, I have a question. Thank you so much for this presentation. It's been so helpful and empowering, especially, you know, when you mention about women being financially illiterate. It's so true. I don't know where the stigma comes from of not being more informed about finance, but with us being more involved in the economy, we should be literate. So thank you for this. And the gentleman who also presented. So my question is, when you were talking about investing, I'm kind of lost and intimidated by the playground of investing and which direction to go. I was encouraged to open a Roth in my 20s, and I did, but due to some financial strain, I haven't been consistent in contributing into my Roth, and I know it's for my betterment towards my retirement. So then I started hearing about different apps of investing, and I don't even want to get into the blockchain and the Bitcoin business, but like Robinhood and other apps of sort of self-service, what do you suggest is the most user-friendly, comprehensive app to start off in investing?
Hi, Joy. Thank you for your question. I would say, as someone who has used Robinhood in the past, I think that was the easiest to understand. I'm certainly not endorsing it, but a Robinhood is simple to understand, and it gets you access to the vast majority of things that you would consider investing in. I am not giving financial advice here, but I think it just a safe thing to do that a lot of individuals choose to do when they do invest, to take a lot of the stress out of the equation, is to invest in an ETF, to invest in an exchange traded fund like the S&P 500. You can go online and you can look up these different ETFs, and you can see what's behind them. So for the S&P 500, for example, it's 500 different companies. So going back to the point on diversification, this is one of the investments that you can just choose to buy and hold for a long period of time, whether it be a year, 5 years, 10 years, 20 years, 40 years, 50 years. I personally have a fair amount of that as part of my portfolio. But there's so many resources out there, but it's also very easy to get lost. You mentioned digital assets, something that I personally stay away from because I don't understand, and a lot of people say that they understand it and don't actually. So it's very important to figure out where you're getting your information from, and whether or not the person is actually like a trustworthy source and not someone who's on Instagram or TikTok putting out videos for just purely for views.
Great question. George?
Yeah, no, great answer, Nikolai. Just to add on to that, I've also used Robinhood. This is not me endorsing it, but Robinhood does gamify that investing experience. It is your money. It is not something that you want to just play with, throw it anywhere that you want. This is not considered financial advice, but I use Charles Schwab. I think they provide some of the greatest research platforms that can aid you in finding your investment ideas and something that will suit your risk appetite. It does require a bit of research, but all that is provided on their platform. And I think it's a great tool to educate yourself on. Thanks.
Okay, because I was about to ask that, but Charles Schwab was one of the examples. My follow-up question, but you answered that. So I'll look into those resources for assistance as well. Thank you.
Great, thank you. Any other questions? I know that we're about at time, but I appreciate everyone joining us tonight. Thank you to our panelists again for speaking with us and kind of sharing your knowledge. It's definitely insightful, and really thank you for joining us and sharing this with our community here. So I can pass this on in your mod to close out.
Yeah, there were so many great takeaways from today's workshop. I actually took some notes myself. Checking your credit score monthly, importance of early investing, but also just the importance of removing the gender pay gap that currently exists. So thank you all so much. Nicole, thank you for all of your support in putting together this and moderating it. Nikolai, George, and Mary, thank you for your expertise and for providing our community with these amazing resources. Deb, thank you for all of your tech support throughout this entire workshop. And for all of our participants, thank you so much for joining us and for being so engaged with your thoughtful questions. I will be sharing the presentation deck with everyone post workshop, but if you have any other questions, we'll stay on for another minute or two, but thank you all so much for joining us. Please stay safe and well and have a good rest of your night.
I had a quick question. I'm sorry. Can the presenters put their email in the chat in case I come up with a question later on? Is that fine?
So when it comes to the 311, I want everyone to understand they're not a burger.
Yes.
Thank you guys so much. This was an amazing presentation. Thank you so much for having this.
They have to answer it.
Chris.